Global markets are opening the week on a more defensive footing, with the macro narrative shifting back toward geopolitical risk after a deterioration in U.S. Iran negotiations and renewed uncertainty around the Strait of Hormuz. The key driver over the past 24 hours has been a reintroduction of escalation and risk, with both sides still far apart on the core structure of any agreements. That has pushed oil prices higher again, reestablishing an inflation risk premium and forcing markets to reassess what had been a more benign outlook just days ago. In FX, this is translating into a stronger US dollar, with safe haven demand returning alongside higher energy prices. On the equity side, US futures are under modest pressure after the recent run to record highs, as investors take a step back in light of the renewed rise in oil and the implications for inflation and policy. The latest rally had been driven by falling yields and easing geopolitical concerns, but that narrative is now being challenged. If energy prices remain elevated, it raises the risk that central banks, particularly the Federal Reserve, may need to keep policy tighter for longer, which is not an ideal backdrop for stocks at these levels. In commodities, oil is once again the central focus, pushing higher on supply concern and the potential for further disruption in the Gulf. Gold is also holding firm, reflecting continued demand for hedges against both geopolitical uncertainty and inflation risk. More broadly, the energy channel remains the key transmission mechanism across markets, feeding into inflation expectations, yields, and currency dynamics globally. Looking ahead, markets will remain highly sensitive to geopolitical headlines, but attention will also turn to key macro data, including upcoming U.S. inflation and retail sales figures, which will be critical in shaping expectations for the policy path. The broader takeaway is that markets have moved out of a clean, risk-on environment and back into a more fragile, headline-driven phase, where direction will depend heavily on how the geopolitical situation evolves and how that feeds through into oil, inflation, and central bank expectations. That's all for now.